Hello traders, Cousin Vinny coming to you from theclosingprint.com on August the 24th, 2019. In this edition of your weekend video newsletter, we'll discuss the indices which are giving us potential cautionary signals, along with all of our indicators that we follow from week to week. We did note that all of the major tech stocks did move lower last week with the exception of Nvidia, and that the bond stock ratio continues to be short-term bearish. Institutional sentiment has turned lower and is trending in a bearish direction, and NYMO and NAMO still trying to create a bullish cycle. We'll watch that during the week. S&P equal weight index triggered and then failed on day 4 after being above the 9 EMA Monday through Thursday. Friday's tweet pushed this trigger towards the oversold condition once again. Put-call ratio is mixed, and the US dollar was rejected at a multi-top. The yen had a bullish spike last week, and the British pound US dollar turned higher, which should be bearish for the FTSE and the London Stock Exchange in the short term. So be aware of that if you're trading either of those two indices. Bonds are parabolic, but there's some cases that we'd like to cover in today's video that are worth your consideration. Gold was up 2.39% versus the S&P 500 spiders last week, triggering a decision for us to add to our gold positions and GDX specifically on Friday. We also sold covered calls against that GDX because of the heightened VIX condition, closing at 1987. The heat map has really not changed that much despite the selling last week. We did see a slight improvement from 4 weeks ago, something that we need to monitor on a daily basis. The international market's pretty much the same. In addition, we have a shortened list of stocks that we're watching this week. Note, Kirkland Lake Gold KL is on the list. Most of the IBD 50 stocks look very precarious at support, so we will gauge new positions as the markets open and follow through into Tuesday. So we'll add to our watch list this week as conditions permit. Volkowski is showing 505 green with a CPI signal mixed red since August 23rd, moving from 92.9% bullish to 1.4% bearish. I might note that these conditions usually reverse within the next week or so, so this could very well be the bottom in stocks. We'll have to monitor that as the week unfolds. Presently, the condition is bearish with 146 patterns bearish, 2 patterns bullish, and 323 patterns waiting for breakout. The reason why I have the previous week's conditions in parentheses is to show you the big change from week to week. Bottom line, we're very cautionary. We are in a position right now where we might continue to add to gold and to bonds if conditions continue to show weakness on the S&P and the US stock market indices. Starting off with the spiders, we do see what potentially could be a lower low in the short term as RSI turns down. We do have a 7% or greater pullback at around 280. So there is consideration for this to be a descending channel at this point versus higher lows that could play out to start the week. This contrasting version shows that 7.58% drawdown at 279.50. 10% would be 272 from the present high. In this condition, we're looking at RSI to bounce it in the short term. There's no guarantee that will happen. It's just what we're watching for as the week unfolds. The big shift, of course, from Monday through Thursday, it appeared we're going to stay above the 9 EMA. We did. And then Friday, we started out the day looking very strong into the end of Powell's speech in Jackson Hole. And of course, everything changed immediately after the 11 o'clock hour once the president tweeted his message about China, and that changed the picture entirely. So we have to keep an eye on these lows at 282.50, give or take, and what might unfold this week as we start trading on Monday and Tuesday. If we consider the 60-minute chart, we saw the same thing on Monday through Thursday, as tick cumulative appeared to be making a sideways or a bottoming pattern. That failed, of course, once the president's tweet came out, and we dropped close to that 282 pivot point that we saw at the beginning of August, presently just below price action at the present time. We did reverse on Friday at the close, so that's something to consider as well as we start trading on Monday. The bottom line, however, is that as long as this is in a bearish trend, we want to be cautionary and consider trading bearish puts in the short term on the spiders. Do note the oversold conditions on the 60-minute time frame as well. The NASDAQ 100 weekly also gives us reason to be cautionary. We do have the 50-period moving average on this weekly time frame just below this low that we saw 3 weeks ago at 73.56. So that's a potential test. We're at the 50% retracement from this pivot low up to this pivot high. So there is the flip side of this condition where we could see a bounce here, an area where we would consider taking more profits off the table and selling more covered calls on positions we want to hold on to, as VIX is elevated and premiums are very high. IWM weekly is sitting right at support as of the close. This is an area we must hold, otherwise we'll probably revisit that 125.03 pivot low that we saw back in late 2018. A bounce, of course, from this area would change things dramatically to start Monday and Tuesday, but highly unlikely at the present time, as RSI continues to suggest we could see a break of this support level this week. And if that were to occur, you could also consider taking puts on the IWM on any bounce that is rejected at this support line as we start Monday and Tuesday. Looking at the S&P 1500, the S&P 500, S&P 400 mid caps, and S&P 600 small caps, we're still in a condition that warrants caution. We did go to a buy signal short term. Of course, that was based on the previous week's price action into Thursday, negated on Friday as this index pulled back, and you can also see the histogram is confirming that decision. The reason why I like using the S&P 1500 is because it's based entirely on stocks and not on mutual funds, which the New York Stock Exchange unfortunately has an abundance of. More than 600 mutual funds and various instruments that can skew the results from using this measure. Here's a daily time frame. Chris Travacco also pointed this out in his weekend video, which you can also see on the S&P 500 advanced decline volume line, which is in this same ascending bullish pattern. So we want to watch what happens this week. We saw back here in March and late May a move back above the center line of Bollinger Bands or the 20-period moving average. We got rejected on Friday morning due to the president's tweet and the resulting changing conditions. Taking a look at VIX for a moment, this is the 60-minute time frame. When this is red, we do not want to be bullish. We only want to do that when this is green, which would signal potential higher highs and higher lows on the 60-minute time frame. If we see a red signal, we want to be bearish in the short term. We're potentially at support, and this could turn very quickly, which resulted in the decision on Friday to buy some VIX puts, knowing that we could spike into the green zone. Presently, up until this point in time, beginning in August, we put in a series of lower highs. So if we do reverse, I've noticed that in the past 12 months or so that VIX does tend to reverse within a day or two after hitting the green zone, and something that could happen this week. If we do rise to 25 or 26 on Monday and Tuesday, I'd most likely add to my VIX puts in the short term. I have the puts that expire the first week of September. Additional breadth indicators that did not spike to minus 30 on Friday, which I find pretty interesting. S&P 500 advanced decline percent in the upper panel, mid caps, small caps, and the NASDAQ. So I would have expected to see more selling given the gravity of the situation on Friday's close. So this is a developing situation and something that we'll watch for a potential bottom if we do reach minus 30 this week, which might correspond to the 200 period moving average at 2802.52. Both the NAMO and the NIMO. This would be more bullish, obviously, if we start breadth improving on Monday. Remember the previous chart of the advanced decline percent of the big caps, mid caps, small caps, and NASDAQ. This has the potential to continue higher if we spiked minus 30% quickly and reverse. We're at a support zone. So if you're bullish, you want to see a bounce here on Monday. If you're bearish, you want to see these lows give way. We see the put call ratio at an elevated condition at 1.19. This is the total put call in the upper panel. Spikes above the upper Bollinger Band have led to reversals in the short term. Spikes to the downside give us reason to be more bearish. So if we see a spike to 135 to 140, 145 or so, first thing on Monday, we'll stick with our VIX puts and look for a reversal in the short term. If for some reason the markets go crazy and we see a move down to the lower bands, then we would consider positioning more bearishly. So you can see that there are a lot of mixed signals in the markets and reason to be neutral and not biased on any given day as this news continues to unfold about China and the U.S. tariff situation. Here is the 10-year Treasury yield. Previous occasions where we've spiked down into this zone where we find ourselves on Friday's close. 137 was the low in 2016, which led to a nice bullish trend to follow over the months into 2017 and 18. So be aware that we could very quickly reverse in the short term, something that we need to watch on a daily basis as the S&P 500 continues to produce higher highs and higher lows at the present time. Taking a look at junk bonds and high yield corporate debt, HYG, we have yet to lose the 20 period moving average on this weekly time frame like we did back here in October through the December low. So this would be a signal as well to position more bearishly if we do lose the 20 period moving average on the weekly in the short term. Here is the Barclays Aggregate Bond Fund, AGG. This is what the bond traders use as a benchmark. Continues to push higher in the short term. From the October lows, we will have been in this position 12 months come October if nothing should change. We have about a 40% allocation in fixed income investments, TLT and AGG in our retirement account to give us a balanced approach. Right now it looks like that bonds could continue moving higher. Contrast that with the 20-year bond, TLT, which showed a lower high from the previous week, hitting 148.60 and then reversing last week. So we do have an overbought condition that could fade further. This does seem quite parabolic. We'll take it day by day, But at the present time, we do have some puts on TLT. We didn't add to our position, especially on Friday, considering the change in market sentiment. So we'll keep an eye on TLT in the short term as well. I did want to reflect on something that Chris pointed out in his weekend video. Note the descending trend line and the rejection in 2016, which marked the pivot low in the current cyclical bull market that we've been in for the last 3.5 years, and the rejection at this trend line, which led to this ratio moving lower while the S&P 500 moved to new all-time highs. We're at that trend line now. We'll have to keep an eye on what happens this week. Obviously, on this weekly time frame, we could continue rising, in which case we'd look for the S&P 500 to test this lower trend line. Shifting our focus to the US dollar, if the dollar does find these highs insurmountable and starts moving back towards the 200 period moving average, that would create something of a tailwind for US equities, yet another mixed signal and a reason to be more cautious this week. If the dollar does move lower, look for gold to move higher, which is yet another reason why gold outperformed the S&P last week. For the week, it was up 2.39%, breaking this trend line that goes back to 2016. The pivot high that we saw in the beginning of 2019 in gold, now breaking out above this trend line. With PMO moving higher and above its signal line, we could see a further increase in gold positioning in the weeks ahead if the dollar continues to move lower. And another chart that gives us reason to be more cautious at the present time, copper, which is a leading economic indicator of sorts, being construction uses quite a bit of copper, not only in the US but globally. This could lead to further deterioration in this economic indicator, which would correspond into being more defensive in our posture in our retirement accounts. And of course, there's crude oil. For the last 12 weeks, there was one occasion where we moved briefly above and closed above the 20 period moving average on the weekly time frame. Being this is positively correlated to the S&P and equities, we'd like to see a bounce in crude oil that is sustained over the next few weeks and take out this pivot high if we're bullish equities. This is yet another thing that we want to confirm and we'll look forward to in the weeks to come. For now, this is telling us to be more cautionary and defensive in our positioning over the next few weeks until we regain the 20 period moving average on the weekly. A reminder that the heat map didn't change much. We did see a change for retail, staples, food and beverage, and the REITs improving in addition to utilities. So we did see a bit more green. When we see these shifts from crimson, red to lime greens and greens, we look for better things to come. So this is a week by week tally. As of 8/23, this is looking a little better. The international markets also giving us reason to be a little bit more neutral and cautionary as the week develops, as China, believe it or not, actually improved last week. All of this is happening, of course, as the ratio between consumer discretionary, bullish, versus consumer staples, bearish sectors, looks like we're trying to turn back up. Here is September, October of 2018, where these moving averages drop precipitously, turned in January, February, flattened out over the last few months during a period where June through August, the beginning of August, the markets actually were trending and moving higher. We started moving a bit lower presently, starting to look like September. Now we see the moving averages trying to change direction. So what happens in the short term needs to be focused on as we go into September, seasonally the strongest months of the year. Left to be seen, but something we definitely want to keep an eye on in the short term. Real estate above its 20 period moving average. The 20 period is basically putting in higher highs, higher lows. It's trending bullish. We'll look for a bounce. Interest sensitive stocks. Transports, we really need to see a bounce here if you're bullish equities. Transports are extremely important. If we lose these lows here, that would be bearish and reason to be more cautionary in our positioning. Biotech, about to lose these lows. Biotech's yet another risk on, risk off indicator. If it were to lose these lows at around 78 or so, that would create a condition where we'd be more bearish in the short term. XLB materials bouncing at the 200-day, flat for the most part, looking for a bounce, descending pattern, price action below the 20 period, above average volume on Friday. MACD below its signal line and dropping. Communication sector, Netflix, Disney, Comcast, Fox, etc. This is holding these pivot lows along in this area. That needs to bounce. We could visit the 200-day RSIs below 50, respect the trend, which is presently bearish. XLE, looking for a bounce. This is the weakest sector of all 12 sectors that we follow. XLF, holding near the 200 period. Banks, looking for some support and some love in the short term. Industrials, same idea, 200 period moving average. Huge volume on Friday. Technology moved briefly above the 200 period moving average. We were starting to get more bullish as we spent 4 days last week near or above the 9 EMA and 20 period moving averages. We had support up here, volume by price histogram on the left. We've since lost that, so could go either way. Draw a trend line through these levels here. Do we bounce here on Monday? Hard to say. XLP, consumer staples, at the 20 period moving average, finding buyers. Above average volume. MACD still above its signal line. Utilities at highs. Interest sensitive. Healthcare, a triple bottom zone right in here, could come down to this low as well if we still see more weakness in healthcare. And consumer discretionary, trying to put in higher lows, was above the 20 period moving average Wednesday and Thursday, lost it on Friday. So all of these sectors are giving us mixed signals, reason to be more cautious in the short term. IBD 50, we have mixed conditions here. Some of the leading stocks like Adobe are below their 20 and 50 day. We got a crossover on Adobe. We have the support zone at 280. Other stocks like Arch Capital remaining above the bullish 50-day moving average, 20-day moving average needs to be regained. Same thing with Eris Management, Team, and Chipotle, to name a few. A lot of these stocks like Discover Financial below their 50-day and 20-day moving averages, losing lows here in the financial group. Names that we want to keep an eye on. This week we like gold stocks. As a consequence, Kirkland Lake looking very strong. Nice push off of the 20 period moving average. We saw the same thing with GDX. One of the reasons why we took a long here, and we sold covered calls at the top of Friday price action with VIX elevated. Premiums are very high, so we're capturing that and giving ourselves a little bit of downside protection at the same time collecting premium. We're also watching stocks like Mastech, which was very bullish going into last week until Friday. It did hold the 9 EMA, which is very interesting. I'd like to see it pull back to the 20-day and find buyers like it had in the past with a bullish condition in RSI and price above. We'd look for a bounce. Of course, with our cautionary stance this week, we're taking very few positions on Monday to start. We'll wait until about 10:15, 10:30 before we do anything after the opening range. Stocks like PagSeguro, which broke out of this small flat base 2 weeks ago, came back to that zone, found buyers into Wednesday and Thursday. Friday, very small pullback. It's above the 9 EMA, Both the 9 and the 20 are trending RSIs above 50. So this is one that we'll keep an eye on to see what relative strength might persist on Monday and Tuesday. Looking for higher volume on any moves to the upside. Paycom Software, same idea. Held the 9 EMA, tight price action for the most part. RSIs above 50. Volume increasing. This is what we like to see on PagSeguro, PAGS. Above average volume and ascending as price action is remaining bullish. Paylocity, PCTY, same idea. At highs, relative strength, RSI above 50. Price above the 9 EMA and 20 period moving averages. QE, very strong. Hasn't been on the IBD 50 for over a year and a half, 2 years, I believe. QE is one we've traded before. It operates electronic online payment systems in Russia and Cyprus, the banks in that area. Very curious to see this breaking higher on above average volume. Earnings reported last week, August the 19th, a beat of 117%. What we want to see is annual sales and earnings climbing, as we see, and strong IBD metrics, which we also can confirm with relative strength line climbing. It did recently break out of a base. It's 40% above that level. This breakout at 1641, something that we'll be keeping an eye on over the next couple of weeks. RealPage is another company that we're watching, showing relative strength, RSI above 50, price above the 9 EMA and 20. Fairly large, flat base, cup and handle pattern. Looking for a follow through. It provides on-demand software for managing, screening, leasing, and accounting in the rental housing industry. This company has been doing very well. Good annual sales and earnings. You can see how it's been climbing over the last few years as it's been on the IBD 50 from time to time. And we've traded from 93 cents in 2017 annually to a projected $2.06 for 2020 with decent IBD metrics and RS line climbing. Looking for above average volume. Last report, 16% beat, 37 cents versus 43 cents back on August 1st. Many of the IBD 50 stocks look like StoneCo and Adobe, sitting on support, RSI below 50, price below the 9 EMA and 20. This leads me to believe we could see further downside in StoneCo and stocks like this. Store Capital, another REIT above its 9 EMA. Nice push on Thursday, negated somewhat on Friday, but it is showing relative strength. It's overbought, above average volume on Friday. So we'll see how this opens on Monday and Tuesday. Perhaps we get a bounce and buyers step up, in which case we'd look for this to be moving higher. I like the REITs. With the low interest rate environment, investors will be chasing yields. This is one stock that pays a decent return on your investment. Synchrony, like many of the other financial names like Discover Card, etc., losing support levels, following through into Friday's low, with RSI nearly oversold, price below the 9 and 20 period moving averages, which are in bearish trends. Trade Desk with a reversal on Friday. I'd like to see that back above the 20-day. Building a flat base. RSI needs to move back above 50. I know some of you were trading this last week. Ulta Beauty, another name that needs to regain the 20 period moving average, showing weakness on Friday with RSI below 50. And watch Workday, which did have a pretty good day going into Friday morning until that tweet came out and reversed a lot of people's perceptions of the markets in the short term. Look for a follow through. Workday could continue to move higher. I'd look for RSI above 50 and price action to take out the upper half of Friday's price range at a minimum. Hopefully takes out the 200 zone. Looking for the right side of a cup building in the short term. Additional stocks that we like to trade from time to time. You can use the MarketSmith tracked screens. This is a very good scan to run. Relative strength line, new highs while the market's in correction. Let's take a look at some of those names. You can pause the video and take a snapshot. I would look at stocks where a volume percent change is rising and you have a positive close like Paycom. We saw Paycom already. You have Kirkland Lake Gold, positive on the volume percent change versus the 50-day, and price change also. So look at these names for potential trades. Here's Crown Castle. Let's see what that looks like. Breaking higher, just above the pivot breakout zone. All right, so it's only 6% from the breakout, and it's just out of the blue area, which is the area where you want to buy. Maybe it pulls back a little bit to the 9 EMA, and you can pick it up there. Annual sales and earnings climbing, good IBD metrics. You got relative strength line climbing, and volume almost above average on Friday, despite the move lower in the overall indices. We can also look at stocks that are producing better than 100% volume. That's something very useful as well. We look for stocks that are showing relative strength and volume increases as well as price. So we can see Carbon Black, of course, that being a buyout by VMware. Fastly, DRD, I believe, Susie, you might have mentioned this one on Friday. Breakout, fairly cheap name. South African company engaged in the exploration and extract of gold in South Africa. Above average volume. Relative strength line climbing. Annual sales and earnings, not that great. IBD metrics, not that great, but it is showing up on the volume scan, which is what we are looking for in this case. Let's see some other names. Intuit, we talked about on Friday. OPRA, let's see what that looks like. Norway-based company designs and develops web browsers for mobile phones and PCs. This one looks pretty interesting, not that expensive. Looking for better numbers here on annual sales and earnings, but it is starting to show some interest. Obviously, the volume above average. Okay, traders, that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com. I'm sorry the watch list isn't larger, stocks that we're watching, but most of the IBD 50 stocks look precariously weak and something that we want to keep in mind as we trade into this new week. I'll send out a watch list. Expect it to be smaller than usual at around 11 or 11:30 in your inbox on the East Coast and around 8:30 on the West Coast. It's beautiful outside. You'd like to spend some time with the family. There's really not a lot to report other than the first part of this video, which told you to be more cautious and consider that we could see more downside in the short term. Take care, have a great weekend, and we'll talk to you tomorrow. Have a great day.